All right. Thank you very much, everyone, for joining us tonight. We have a wonderful seminar tonight for you on long-term care. Your presenter is going to be Scott Fisher. He's a financial consultant with the John Graham and Associates team. We will have time at the end of the seminar for questions, so please save them for that time. You can either raise your hand or type it into the chat when it's time for that, and we'll get those questions answered for you. We really appreciate you all joining. We do this every month. We love doing these seminars, so please feel free to pass along any invites or information on this to any of your coworkers, loved ones, anyone at all you think might find benefit from attending one of these. So without further ado, Scott Fisher, take it away.
Awesome. Thanks, Chris. I'm going to go ahead and get started here. Okay, so my name is Scott Fisher. I'm one of the financial advisors here on our team at John Graham and Associates. And so tonight what I'm going to go through is planning for long-term care. And so, talking about long-term care, one of the main things I think we always get asked is, well, what are the chances I actually go into a nursing home or need have to use some type of long-term care? And the answer to that is pretty surprising. So the statistic here on the screen is if you reach the age of 65, about 52% of people are going to use some form of long-term care in their lifetime. The Alzheimer's Association here as well also has a statistic that when you hit the age of 65, 1 out of 10 are going to develop Alzheimer's there at some point in their life. So what we also know with some more statistics is the average age that you're going to use a long-term care services is between 83 and 84. And so a lot of what we're going to go through here today, and talking about financial planning, we always common to hear about planning for retirement and looking there into the future 30 years. Well, long-term care is similar with that. Is what we're planning for is something that you might not use for 20, 25 years, and you might not use it at all. And so, but what the stats show us is that you do have a high likelihood that this is going to come in to be a part of your financial plan there later in life. So what exactly is long-term care? So the definition here is the ongoing services and support needed because of chronic health conditions or disability. And so through that, there are 3 levels of care. You have the skilled, the intermediate, and then the personal care. So the skilled care is going to be with licensed medical professionals with around-the-clock care, basically multiple times a day and throughout the day. The intermediate care now is still going to be professional medical nurses, doctors, therapists, but just not as an extensive as the skilled. And then the last is the personal care. And so that would be more of the caregivers, nurses aid, things like that. Now, the level of care can happen in different locations. And so, you can either, I think what's most common and what the goal for a lot of people is to be able to stay home. And for that is a lot more of that personal care where you might have somebody come in, help cut the grass, clean the dishes, do some of that housework as you get older to kind of free up your space, your time to focus on other things. The assisted living facility or other senior living facilities. Now, those are great options as you get older, that you still have an independence where you might have your own apartment kind of within the assisted living facilities complex. However, they do have those skilled care physicians there on staff that you're able to, can help you with anything if needed, in a lot faster than living at home. Now, the third place to receive care is going to be at an adult daycare center. And so these centers are a great solution with Alzheimer's that can provide, around the clock watch for either yourself or your loved ones. And then the last is a nursing home. And that's going to combine all three levels of care, where they will have, skilled care, personal care, and the intermediate care there as well. So a lot more flexibility there in the nursing home. That also gives you a lot of different pros and cons. So how much does it cost to go into a nursing home? Well, I know if you've either experienced it with your parents or with other family members, it's not cheap. And so here, as of 2019, the average nationwide cost is about $82,000 a year. And so, again, coming back to one of those statistics, is the average age when this comes into play is about 83 to 84 years old. So if we're 65 today, we still have, another 15 years or so until we might need this. So the $82,000 is today's cost. However, we want to project that out to when you are potentially going to need it. And so just some simple time value of money. If that rate increases 3% over the next 20 years, what you're looking at is about $148,000 per year for nursing home care. Looking forward into 10 years, it's going to be about $110,000 or so. So we know it's not cheap today, and looking forward, the cost is most likely not going to be going down anytime soon. So we know it's expensive. Now, well, how can we be able to afford the nursing home? How can we have a plan in place? What are my options to help carry that cost? Well, really, we have three options of what you can do. The first one is going to be paying out of pocket. The second is paying or mostly relying on Medicare and Medicaid. And then the third is purchasing a long-term care insurance. Each of them have their pros and cons, and that's what we're about to jump into here right now. So, paying out of pocket. This is has the biggest pro to being able to pay out of pocket is that freedom to choose where you would like to receive your care. So, hey, you can either pick a nursing home here locally or in Chicago, down in St. Louis. You have that flexibility because you are the one paying. And that freedom is, can be very important to a lot of people. Now, with that out-of-pocket payment comes, well, this is really only ideal if we're very wealthy and have the realistic payment to have that be able to pay for the long term. Because that biggest downside is, well, what happens if we run out of money? And so with that, as we look to if we were to run out of our assets, then we're either relying on family members or leaning back on the Medicare and Medicaid options there at the end. And so beyond the worry of running out of money, you also have to be willing to liquidate assets if necessary. So if your pension and Social Security income doesn't pay for the whole bill, you might have to look to either liquidate your retirement assets, your non-retirement assets, possibly farmland, to be able to pay those bills over the long term. Which does have that negative impact if it was important to you, or if it's in your financial plan to be able to leave an inheritance to charities, to other family members, and to be able to give back. Now, the outside of paying out of pocket, there is, just by paying cash, there is a solution of what's called a reverse mortgage. Now, I will say that, in our experience, we have not, this is not a very popular option for a lot of people. Can work in very specific situations if we know the risk. And so really, how to explain the reverse mortgage, the best way is to be using an example. And so the reverse mortgage, when it is the best situation, is when you can stay at your house for an extended period of time, and it would help pay for at-home care. And so, for example, if you have a $300,000 house that you have paid off, you do not have a mortgage, the reverse mortgage works as you're able to, the bank will say it will lend you $150,000. Typically, they will not give you the full amount of what your house's appraisal for, simply because of the risk that's involved with it. So if they give you $150,000, well, as long as you're still living in that house, you do not have to make those mortgage payments back to them. So it's not a home equity line of credit or a second mortgage. And so that $150,000 that they gave you can be used to help pay for at-home care. Maybe you put a ramp outside instead of having stairs, or redo your bathroom to make it more handicap accessible, things like that. However, when you do either vacate your home and leave into an assisted living facility or nursing home, or that you do sell your home, you have to repay that $150,000 back plus interest. So you are giving up some of that equity within that home mortgage, or that home value really, and giving up a little bit control within there too. So with that comes, you want to make sure that that plan fits your specific needs before just pulling the trigger on getting a reverse mortgage. So outside of out-of-pocket, what you can do is rely on the federal government. And so there, through the Medicare, is the federally funded health insurance program. There, as soon as you hit the age of 65, you're able to get onto Medicare. So with Medicare, the reality is their long-term care, they don't really pay for much. So before the Medicare and the government will step in and help paying the bills, well, first you have to be hospitalized for 3 days. If you're only hospitalized for a day or two, again, you don't hit the qualifications. It has to be 3 days. After those 3 days, they will pay for skilled nursing care for the first 20 days. And then they will partially pay the cost for the last 21 through 100 days. After the 100 days are up, Medicare does not supplement any other skilled nursing or any of the other cares. So in addition to that, they really don't pay for any personal or custodial care on top of that as well. So, the reality is that Medicare is a very short-term solution and is not going to be a long-term solution for many people. All right. So outside of Medicare, we do the other program is Medicaid. So when we look here at the chart on our lower left, what we really see is that Medicaid is the largest public payer of long-term care services. So majority of people that are using that have a long-term care need, Medicare is paying for just about half of those people. Now, the downside of Medicare is that it is means-based. So it is either meant for the poor or you have to become poor to go on Medicaid. So the other big thing with Medicaid is that you do give up the control and that freedom to pick where you have your care, because Medicaid will only pay for certain nursing homes that they have contracts with, that where they have open beds. Now, whether that's in Peoria or Bloomington, or you have to move to Quincy, you don't have that option. It's just wherever a bed is available for you. So as we talked about here, or as I talked about there last slide, that is Medicaid is meant, for the poor. So what is the eligibility with that? So every state is going to be a little bit different, has different criteria under those federal guidelines. But at the end of the day, to qualify for Medicaid is two things. It looks at the income and your assets. So step number one is your income. It's going to have to be less than the cost of care. So if your income is $5,000 a month through a pension, and your care is only $4,000, makes a lot of sense. The government's not going to help out. They're going to tell you to spend your own money. Now, if that cost of care was $10,000, then they'd be able to, you'd much more qualify on the incomes need based. Now, on the asset side, in most states, that asset limit that you're able to have is $2,000. So that is $2,000 between your checking account, savings, IRAs, non-retirement accounts, any other investable assets. You would have to spend down to $2,000 before the government will step in with Medicaid. Now, there are some assets that do not get counted towards that $2,000. So for example, if you are married and have a spouse, your house would be one. You are eligible to still keep one car. Any household or personal belongings, you can still keep that big flat screen TV, term insurance, and then burial plots or any prepaid funeral expenses. So Medicaid planning. Now, what exactly is that? So what we mean by it is that your long-term care plan is to go on Medicaid. And so if that is a plan, if that is someone's plan, well, there are some strategies that you can put yourself in a better position when it comes that time. And so one of the first bullet points there is, hey, that you can use those assets that you have, that instead of spending it on those long-term care costs or nursing home rent, that you'd instead spend things on like a small term life insurance policy that would not count against you in those assets. If you joined us there last week or last month when we talked about estate planning, You could also transfer those assets into an irrevocable trust. The irrevocable trust, what that does is the donor or the grantor is going to be giving up all the rights to those funds in the trust. And so once you put them in there, you're not able to get them back out. The other third strategy there would be to start gifting away assets. And so instead of spending down and giving more money to the nursing home, that you're able to give those inheritances while you're still alive to family members, to charities, to spend down your net worth. Now, so of this, there's pros and cons to it. And so the main benefit of using these strategies would be, hey, you're going to qualify for Medicaid sooner because you've already spent down your assets, that you already meet that $2,000 limit, you already meet the income limits. Also, what allows you, that planning aspect allows you to still give that inheritance and preserve assets for loved ones, might help protect the healthier spouse there as well. However, with all the benefits, there are some drawbacks there as well. And with that does come an ethical issue for some people, where we might have a strong net worth and we're spending it to use public aid. In addition to that, putting money into that irrevocable trust, you're giving your rights up to your assets, which is not easy to part with. And then lastly is the Medicaid laws. They're complex. They're not easy to understand. And so one of the kind of prime examples of that is that the Medicaid does offer or does have a look back period. And so that look back period is 60 months. And to really explain what that is we're going to walk through this example here, where if you had, if you owned a house, that house is worth $400,000, and then as you've gotten older, you have created that need to move into a nursing home to receive the level of care that you need. So right away you say, well, what I'm going to do is I'm just going to gift that house over to my son. That's no problem. Now I don't have a $400,000 asset. Instead, now I have I hit that $2,000 limit. I'm good to qualify for Medicaid. Well, not technically with that look back period. And so what they do is, with the average cost of the nursing home around you saying it's $8,000 a month, what they did was they took the $400,000 asset, divided by 8,000, and you're ineligible for 50 months. So that means, in the eyes of the government, they just said, hey, you just sold your $400,000 house, spend all of that money before we will pay. And so they will not pay any, or the Medicaid will not step in and help pay any bills for the first 50 months of that. So that's one of kind of the planning aspect where, hey, if we do want to transfer assets, or transfer, in this case, the ownership of a house, that you would want to do it earlier, beyond that 60-year or 60-month look back period, so that doesn't hinder your eligibility for Medicaid in the future. So a lot of it comes back to the planning, something you need to do or thinking about earlier rather than later in life. Now, the third option, long-term care insurance. So what this does is it takes that risk of those the annual amount paying to the nursing home insurance, it takes that risk off of your financial plan and it puts it onto the insurance company. Same with, hey, any other insurance, car insurance or homeowners insurance gets the risk off of your books and onto somebody else's. And so where the industry has seen a lot of value is for the middle income Americans who still want to be able to leave back an inheritance for the future generation or for charities, and still have a high quality of life. And so with that, you still have the option, similar to paying out of pocket, of where you do choose that care. And so with that as well, is that since the insurance company is paying out a benefit, allows you to not have to spend down any of your assets, which again comes back to having that flexibility to give an inheritance there in the future. So how exactly does the long-term care insurance work? Well, first, you do want to be young enough and in good health when you're looking to purchase the policy. What we've seen in the industry is kind of that prime time is anywhere between 55 and 60. Now, anytime earlier than 50 years old, typically the insurance companies, you're just too hard, you're too young to measure that risk, so they really don't give you the best rates. But at the end of the day, the premiums are going to be based on your age, your health, and then the different features or benefits that you have within that policy. So if you have the long-term care insurance, the insurance company will not start paying those benefits until you either become chronically ill, cognitively impaired, or that you need help with the 2 of the 6 daily living, what are called the ADLs. So for example, those ADLs would include being able to bathe by yourself, eating, getting dressed, walking, going to the bathroom by yourself. Those are just to name a couple. So if you're unable to do 2 of those alone, then that would be a triggering event to have the insurance start that benefit process. Now, they will not just start paying benefits from day one. You will have typically an elimination period. And so with that comes, you might have to wait 10 days, 60 days, 90 days before the insurance company will start paying that benefit. So the 5 key features that are going to affect what your premium amount is going to be, the first is, well, the actual benefit. How much is that insurance company going to be paying out on your behalf? And so those benefit amounts range. What's popular is as low as $50 a day to $350 a day. Now, the more benefit that you're asking for, the higher the premium is going to be. Pretty common sense, just like life insurance. Now, the second feature is going to be that benefit period. And so how long is the insurance company going to pay those benefits for? It's very popular to see 3, 4, 5 years the insurance will pay for. After that term, they've paid out what they promised, you're on your own. There are policies with unlimited benefit period. However, that is a rich benefit and tends to hold a higher premium than that 3-year benefit period. The elimination period I just spoke about there. That's going to can range to 10 days to 90 days. The shorter the elimination period, the more expensive the policy is going to be. Location of care is going to be number 4. Now, what we mean by that is now not so much of if it's going to work at this nursing home and not that nursing home, but it's more of will they pay benefit at home care services? Will they pay benefit at the assisted living facility? And if it's not in a nursing home. And so that's one of the clear definitions that you want to make sure, if your goal is to stay at home as long as possible and not go into a nursing home, that your benefit through the insurance is going to help pay those for that cost. The last key feature there is the inflation protection. And recall into a couple slides ago, we see that, well, we know it's not cheap. It's $82,000 as of 2019. In 20 years, it can be as high as $148,000. Well, if we are buying this policy today at $350 a day for the benefit, well, in the inflation protection is going to automatically increase your daily benefit on an annual basis. So that allows you to, as the cost increases there over time, that your benefit is staying in line somewhat with that. Or you can have it in your benefit increase, 3% annually, some as high as 5% annually, to make sure that your benefit today will cover that same percentage of the cost there in the future. So how do we manage those costs? Because now long-term care insurance, it is very easy to have an expensive policy. And so one of the main things is, well, the younger you are, the less expensive the premiums are going to be. Now, what we do want to make sure is that you're buying a policy that you can afford today and in the future, as well as if the price may increase there over time. So you always want to make sure that you're buying exactly what you can afford over the long term, because the last thing that you would like to do is pay 15 years for a long-term care policy, have the premiums become too expensive because of the features over time, and that you have to drop the coverage, after paying for so long, and that you might need that benefit there in the near future. And then lastly is you want to make sure that you're buying from a reputable insurance company. You want to make sure that if you're paying these premiums, especially over that 10, 15, 20 years, that they're still going to be around there when you turn 83, and when you're knocking on their door, telling them to start paying the benefit. So that's just a couple of different ways to be able to make the cost manageable. Now, there are some government incentives to having this insurance. So the main thing is working through this gets a little complex and hairy, jumping into some tax regulations. So we would recommend to be working with a CPA or your tax advisor to go through and see if you would qualify to have these exemptions on your taxes. So, but really when it kind of comes into is that if you have an excess of medical expenses that you're allowed to deduct, the long-term care insurance premiums could be added into your medical expenses that can help you maybe future deduct those from your taxes. So that's really what we're kind of walking through here on this slide. So there are everything the type of insurance that we've just been walking through is really what's called the traditional long-term care insurance. Now, there are, as our industry has seen changes over the years, we have seen other types of long-term care insurance policies. A great example of this is what's called a hybrid policy, is where in its core, it is actually a permanent life insurance policy. So where you either pay a one big lump sum downstroke premium, or you pay, over 10 years, a larger annual premium. And with that comes, you have life insurance. And so if you were to get hit by a bus or you weren't, using the long-term care benefits, you do have a death benefit that can go to your loved ones. Now, if for if life changes and you do need that long-term care benefit, then that life insurance kind of has that long-term care rider within it, and it morphs itself into a long-term care policy that will be allowed to pay out benefits, have the elimination period, the exact same features that a traditional long-term care benefit would offer. So with that, as I said before, typically you're going to need a large lump sum, as a downstroke payment, either, taken from other life insurance policies that have built up cash value, or just simply, a check right from the savings account. And then lastly is those premium payments do not qualify for the medical expense deduction, as we were talking about before. So as we look to wrap up, here our educational seminar here today, the main thing that we want to talk about is we need to have a plan in place. Now, whether that's the plan of paying out of pocket, focusing on Medicaid, buying insurance, make sure that you have a plan, because there's a 52% chance if you're 65 that this will come into your financial plan. That you want to make sure while you're still young enough that you're preparing to cross this bridge, as I've said many times, around 83 to 84 years old. And having that plan in place can take that burden off of your family from making any of those tough decisions. So we have a little checklist here for everyone. Some takeaways that can help you with that long-term care planning is, go here locally in the Peoria and Bloomington area to figure out, what kind of services, either nursing homes, assisted living facilities, where are they located? Walk in there. How nice is the lobby? How much does it cost as well? That can all be able to give you a realistic expectation, and come back to assess your finances, work with a financial professional to build that financial plan, and add this into, your retirement plan there as well, because you don't want to have to work so hard and done such a great job on the financial planning of accumulating wealth and focusing on retirement, all to just be able to spend all of that money there to the nursing home as we get older. So lastly is we also want to point out there that you do want to work with an estate lawyer. Make sure you have wills, power of attorney for healthcare, power of attorney for financial, as you get older. And if anything were to happen, become incapacitated, that you have the proper documents for your family to make those decisions quick and smoothly without any drama. So with that here, we'll kind of wrap up and open it up to, if we have any questions, you can come here in the chat group and let us know, and we'll be able to help.
Thank you for that, Scott. Yeah, think my biggest takeaway from your presentation is just how expensive care can be later in life, and how much of an impact it can have on your financial plan, and how complicated it all is. So best to have a plan early and work with someone to make sure it meets all of your needs and expectations. So
Yep, and that's, I know what a lot of the conversations I have with my personal clients is, you know, the solution might not be insurance, but we do have to have a plan in place and have thoughts on what are we going to do if this does happen.